Hey there, everyone. Great to be back down here on the floor. I know you all enjoyed Charlie Moon yesterday. You always do when he sits in. He is the GOAT. But here I am back down live on the floor. And what a day to be down here as the NASDAQ just broke 20,000 for the first time ever. Why the big rally today? I mean, CPI came in right as expected, guys. 0.3% month to month, 2.7% year over year. Inflation still ticking up. That's actually a little bit higher than it was in September and October also, but the numbers were right in line with expectations. And what did that do? Well, it made the Fed fund futures, the probability of a cut next week at the Fed's meeting, almost 100% now that they're going to cut by a quarter point. But what's really interesting is, even though that's going to happen, we're seeing rates, the 10-year, actually tick up a little bit. So I think that there is some concern about the longer end of the curve, not about what is happening right now, but that, inflation is really still ticking up a little bit here. But for the meanwhile, the market loves it. The market says Santa's back in the house here and not just hiding. And as I said, we've got the Nasdaq record territory breaking 20 grand for the first time. S&Ps are up 54 points. We're trading right at 6,100 right now. Right literally on the dot, 6,100, and VIX is down about a half a point or so. Can everybody hear and see me okay? Because I want to get right into topic of the day here, if everyone can hear that, because it is something that we've talked about before, but we have not been as in depth as we're going to get into it today. Mike, how are we sounding over there? Good? All right. Wonderful. There we go. There we go. There we go. There we go. Okay, everyone. So we always talk about expected move, right? But what does it really mean, and how does it get affected as volatility changes? Okay, so I want you to take a look at this. Are you rolling the dice when you trade? What I mean by that is not just saying, oh, I think a stock is going up, so I'm going to buy a call or a call spread, or I think it's going down, that I'm going to buy a put or a put spread, but rolling the dice in terms of not trading the proper strikes, and then understanding which strikes we want to buy or sell. That is so key to maximizing out your profitability, guys. And there's so much that goes into it, not just calculating expected move, but also where is implied volatility and Vega. So we're going to take a dive into that, and we're going to do a comparison here as to what the expected moves might be. Zora, it is pretty quiet here on this big day. It definitely is. It definitely is quieter today. Okay, so again, when we trade, folks, it is all about probabilities, right? We want to put probabilities in our favor. Okay, that is the bottom line. Regardless of the type of strategy we use, regardless, bullish, bearish, neutral, whatever it is, we want to get those probabilities in our favor. All right? So, as I said at the top here, expected move versus implied volatility. What is the correlation? Okay, what is the correlation? How do we know what the correlation is? And how do we know if it's good, bad? What does it lead us to in terms of which position to take? Okay, that's right, Bear. We are looking for that edge. Always, always. Before I move on here, does everybody understand, or do you have some questions, which I hope you do, because that's what we're going through today, about the correlation between expected move and implied volatility and what makes things change? Okay, so let me know if I should go on here. Yeah, it is really, really quiet. It is eerily quiet. I see them passing around. I don't know, they're passing around some chocolate here. Is there a bag of bucks going on? No, nope. You guys, I'll tell you what bag of bucks is in a little bit here. Not no. Oh, really? I remember that happened a while ago also, and there were some people that met up outside. I know. All right, sorry everybody, just talking to one of the brokers here. Okay, educate us. Let's do it. Let's do it. Okay, so I've got a position, or I've got an option chain up here, guys. And I just did this a little while ago, so it may be a little outdated, but that's okay. This is when CRM just a little while ago was trading right here, 357.40. Okay, this was a live option chain just from a little while ago. So with the stock trading 357.40, what is the expected move? And these are obviously December 27th options here. Okay, so what is the expected move on this screenshot here, everybody? Put your rough guesstimates in the chat box here. All right, there we go. Okay, let's get a few more in here. Can't wait to tell you about the Bag of Bucks experience down here. Okay, Don, we've got one. Come on, folks. There we go. Now they're coming in. Gilbert. Yeah, great. You guys get this. Okay, right off the bat. Easiest thing to do. Where is the stock trading, right? Look right at the money. Right at the money. So the stock is, 8 cents away here. So that is at the money. Okay. And if we look at that right there, okay. 1670. Okay. Hello, John. Okay. Expected move here, $16.70. Okay. In our next calculation, we're going to round that off to 17. Okay, but good job, those of you that figured that out. And if anybody didn't know how to figure that out or didn't understand that, please let me know. We'll go through that again. Okay, now, here's another chart. Okay, this is an implied volatility chart in Salesforce, in CRM. What do you think? What's your take on implied volatility in CRM right now? Boy, the NASDAQ up 1.73%. Okay, low earnings affected, low today. Okay, anyone else? Any other thoughts? Low. Okay, good. So you guys recognize that. So if it's low, okay, and we can see that, right? We're right here, and if we look at over the last year, we're really down, bare bones. Okay. If it's low, that means that option prices are cheap, at least cheap compared to where they've been, right? And Gilbert, when you say we should be long CRM, do you mean long the stock or long premium, long volatility? Two different things there. You could be long them both, or you could be short one, long the other. Okay, but if we look at this implied volatility chart here, guys, okay, we're, look at this and treat this like you would looking at a stock chart. Are you at support? Are you at resistance? Are you somewhere in the middle here? Well, this is telling me right here that, boy, good, Gilbert, good. I'm glad that's what you said. This is telling me right here that regardless of the type of position you would want to take, bullish, bearish, neutral, whatever it might be, okay, you would rather own option volatility. You would rather own option premium here because the likelihood is, and remember that, that old adage of past performance is not indicative of future results. The past performance volatility wise in CRM Salesforce here suggests, okay, that it's probably going to move higher. Maybe it doesn't move higher, but the likelihood is it's not going to go lower. Okay, so looking at this chart, I want to probably be long some premium. Now, let's talk about Vega characteristics for a moment, because I'm going to tie this all in to expected move and how we measure exactly which options we want to trade instead of just rolling the dice. Okay, so first off, Vega is it's one of the Greeks. I think is the easiest to remember because V and V. Vega relates to option volatility. Okay, so it's the amount that the value of an option will change when IV, implied volatility, moves 1 point. Okay, Vega is the same for both calls and puts. So you'll notice when I go to back to my option chain here, you'll notice when I show all the Greeks on there, I only showed Vega on one side, on the call side. And I do that just to save some space on my option chain. But that's because it's the same for both the call and the put. At the same strike, same expiration. Okay? Your Vega, or the amount of volatility you have in your position, okay, it's positive Vega if you're long an option. It's negative Vega if you're short an option. So you can be long a call and be bullish in the stock, okay, and you're long Vega. Okay, you could be, hang on. See, there's trading across the pit here, guys. People using hand signals, yelling, although today yelling across the pit is a little bit easier. But you could be short a put, okay, which is a bullish position. But if you're short a put, that's short volatility. That's short Vega. Okay, and Vega increases with time. Further you go out, the further the expiration, the higher the Vega is, meaning the higher the volatility risk is. So as implied volatility moves, it's going to affect an option more the further out in time. Okay, back to this option chain here. Okay, we just calculated 1670 expected move. Very good for all of those that figured that out. Okay, so what that tells us is that out to this expiration, December 27th, and again, I know CRM is a little bit higher right now. I'm using this price here of 357.42 when I put this together. Okay, if I just kind of round this off, okay, use $17, and I'm doing that for math purposes right now. So if I take 357 plus or minus 17, that's what gives us 340 and 375 as our targets. Okay, does everybody see that? Does everybody see that? If I'm bearish, I'm going to target down at 340. If I'm bullish, I'm going to target up at 375. It's actually 374, but there are no strikes there. Okay, does everybody understand that? Whoa, hello, hello, hello. Wow, hello. That could have been the order of the day that people were waiting for. Okay, now, we've got the expected range, we got the expected move, we got the expected range. Remember I talked about how on my option chain, my option charts here, I only show Vega on one side, okay? It's not over here anywhere, it's only right here. So the Vega on the 357.5 strike, I'm not going to call or put because it's the same. The Vega on that is basically 30 cents. Okay, 29.96. That means for every 1 point that this implied volatility moves, the value of that option is going to change by 30 cents. If vol goes up 1 point, the value of that option is going up by 30 cents. If vol goes down 2 points, the value of that option is going down by 60 cents. So the Vega of the call, the Vega of the put are each 30 cents. So the Vega of that straddle, which is what we used to help us figure out the expected move, is 60 cents. Okay, does everybody understand that? That means if vol goes up 1 point, the value of that straddle is going up 60 cents. Vol goes down 5 points, the value of that straddle's going down $3. Okay, does everybody understand that? Okay. Okay, now before I move on, guys, there we go. Let's get the wheel rolling here. Okay, let's get the wheel rolling for today. Groucho wants to roll the dice today. Man, that one big order, and then it's like you can hear a pin drop out here. All right, the dice are coming through. Anybody here like to play dice, by the way? Like to play craps? If you go to Vegas or anywhere. When I go to Vegas, which is not very often, but when I go, my preferred game is craps over blackjack. Probabilities are actually better if you do it the correct way. The probabilities of winning, or I should, the probabilities are of not losing or losing less are better in craps than they are in blackjack, and quite frankly, any other table game that they offer. Why is it so quiet on such a positive day in the markets? Great question, Paul. I've got two answers for you. Number one, the news is out. Okay, the news is out. Volatility is down. And number two, it's getting closer to the holidays. It's getting closer to the holidays. Okay, I'll come back to Groucho in a little bit, but so we were back here. Now let's pretend, and I haven't looked at a CRM chart. You can look at anything you want, okay? But let's pretend here that we want to make a move to the downside. Okay, you looked at your charts, your bearish Salesforce. Okay, so you want to make a move to the downside. We just said that we want to target 340 based on the expected move. Okay, great. Well, what are a couple of the things that we could do there? And I already priced these out for you, but based on the reward to risk that we look to get, that we've gone through before, that we've put up our reward to risk cheat sheets in here. Okay, either of these spreads, they would be great. They'd be ideal. If we did the 345, 340 put spread for $1.10, okay, great. Reward to risk at 3.5 basically to 1. We want to, get a little bit more aggressive. Widen out that put spread a little bit. You can do 347.5, 340, pay $1.70, and you still get unbelievable reward to risk, 3.4 to 1. Okay, does everybody see that? Does everybody understand that? Remember, when we are putting together a spread, we always want to target the short strike. That is our short option. That's the one that we sell. So in this case, 340 was the end of the expected range. That's the one we want to sell. And then we kind of back into the option we want to buy based on reward to risk. Okay, great. Now, the question is, what if volatility, what if implied vol was actually 3 points higher than where it is right now? If implied vol was 3 points higher, okay, what would that do to the value of those options and thus the value of the expected move? And now I'm hoping that you're seeing the correlation between implied vol, expected move, and then ultimately the kind of trade we make, whether we want to buy that vol or sell that vol, okay, kind of leads us right to that. Okay. All right, Aiden, good. If implied vol is up, okay, yes, option premium is going to be more expensive. Now, how much more in this situation? Remember what we said here, guys. If we go back a slide here, what was the Vega The Vega of one straddle was 60 cents, right? It was 60 cents. And that is because the Vega of each option, each call is 30 cents, each put is 30 cents. Combine those to the straddle, you got a Vega of 60 cents on the straddle. Okay, John Berg. No, that's not what we do. What do we say that we want to always do? We target the short strike, and that's the option we sell. Okay, that's the option we sell. So in this case, regardless of the type of spread, the 340, 345, or the 340, 347 and a half, the 340 is going to be the one that we are selling. Okay? Okay. Great. There we go. There we go, Bobby. Nicely done. So yes, if implied vol is 3 points higher than where it is right now, that is going to affect the value of the expected move by $1.80. How? That's 60-cent Vega times 3 points in the implied vol gives us $1.80. Okay? So, yes, John, that's exactly what you'd do. You'd be buying the higher strike, selling the target, selling the expected move target. In this case was 340. Okay, so now if vol was 3 points higher, that gives us different targets, right? That gives us different targets. We have to add almost $2 on to the target on either side, making that new expected range 338 to 377 instead of 340 to 375. Okay, well, if we own a spread, which we would be doing here because volatility was really cheap, okay, is it easier to reach the short strike when volatility is really low or when volatility is actually higher? Because remember, we will max this position out if we get to that short strike. So is it easier to reach that short strike, in this case 340 on the downside, when vol is low or when vol is higher? Okay, we've got some differing answers up here. Maybe I should rephrase my question. Hopefully I didn't confuse everybody. Okay. For those of you that said higher, I understand why. For those of you that said lower, I understand why. But let's say this is now the expected move, okay? Because vol is higher. I would not have on that position or either of these, right? Because ideally, I want to target the short strike. So now, instead of 340, I would put on a different spread targeting 337 and a half, which would be the new end of the expected range. Does that maybe clear things up a little bit? So would I rather have a position that offers me great reward to risk with the stock only going down to 340 instead of 337 and a half? Okay, so hopefully you see that. So when vol is higher and you need a larger expected move, what that does is it adjusts the strikes that you need to use. John, we're talking about a put spread right now. We're only talking about put spreads right here. Same concept for call spreads, but we're only talking about put spreads. So when vol is cheap, when implied volatility is cheap, the expected move is smaller. It is contracted, okay? Which gives us a better probability of reaching the short strike than when vol is really expensive and we have to adjust those strikes. John, I'm not sure. Okay, good. Okay. Does that make sense to everybody? And here you go, guys. Final call for the wheel. Final call for the wheel. S&Ps are literally sitting right on 6,100 as we speak. Okay, so if you think about it, it's kind of this, not a vicious circle, but things are all interconnected. When volatility is really expensive, an option premium gets more expensive, and the expected moves are wider. The reason why we would prefer to sell volatility is because it is harder to reach those points. When volatility is like where it is right now, down here, it makes it easier to reach those points. Thus, I'd rather buy something because it's easier to reach where we want to go. But when it's up here, I'd rather sell it because it makes it more difficult to get to those points. Does everybody understand that? It is so imperative to understand the correlation between implied volatility and how it affects the expected move, because then that ultimately affects, excuse me, affects not only the type of spread that we trade, but also the strikes that we're targeting. So I don't want you to be at the craps table and just roll the dice. Okay, I don't want you to just look at a chart and say, "Hey, you know what? In Nvidia, I'm looking at the chart. I'm bullish, right? I think the stock is going to 150 or 155 or 170, whatever it may be." I want you to use the probabilities in your favor of what the market is pricing in. You will be much more successful if you put the odds in your favor and use the probabilities in your favor. Any stock is included, Alan. Doesn't matter what stock we're looking at. Okay? Somebody want to give me a stock you want to look at real quickly? We can look at implied vol and the expected move. John, I am not suggesting anything. These are examples. These are examples. I am not suggesting anything. Okay, ALB, I'm not sure that is a real big high momentum, high volatility stock, Albemarle, but we can look at it. So here is ALB. That is correct. Who, Astro? You, Astro. That is correct. Okay. Implied volatility in ALB. What do you guys think? What do you guys think? If you all had to take a quick guess here. Higher vol, it's harder to reach the further strike, which is why we'd rather sell that implied volatility. But if we already own a spread, if we've already put a position on when vol is really cheap and vol moves up, that's great for our position. Okay, implied volatility really, really, really cheap here. Okay, so whatever you think about the stock, bullish, bearish, neutral, Doesn't matter. Whatever you think about the stock, you would want to position yourself with long volatility because it will be easier to reach that strike. Okay? Nico, no, implied vol is actually, well, it depends. If you're day trading, you want to look at daily, or excuse me, like minute charts, not daily charts like I look at. But implied vol, Nico, typically doesn't change on a day-to-day basis, which is why we look at a chart like this and understanding that implied volatility is mean reverting, which means when it's up here, it's absolutely coming down, and when it's down here, it's absolutely going up. But typically, that doesn't happen on a minute-by-minute basis. These are daily charts we're looking at here. All right, guys, hopefully that all made sense to everybody. What I really wanted to, explain to everyone was that relationship between expected move and implied volatility. Nico, you are very, very welcome. Thanks for the question. All right, the wheel is closed. Here we go. Okay. I don't know, are we a little light on the wheel today, Mike? All right, you guys ready? Here we go. And Bill or Eric? Bill, 8575. Bill, 8575. Bobby, thank you. Is Bill 8575 in the house? Bill 8575, are you in the house? Yeah. Zora, you've already cleaned out our closet of swag. You've won so many times. Bill, please spin again. I think I have most of the merch. You know what, Bill? It's a giving season. In my world, that's called being a mensch. Awesome. Awesome. So you guys can all thank Bill. We'll get you something else, Bill, but let's take another spin at the wheel here, guys. And Paul, you just won, and I can't believe you're winning again. Come on, Paul. You still here? More than welcome to come on anytime. You want to explain to everybody what's going on? Got it. Oh, got it. We should get everybody down here on a wheel one time. That'd be like our bag of bucks. Paul, there we go. All right, Paul, you know what to do, right? Yep, Paul is here. You know what to do. You know where to find us. Shoot me an email. We'll get it right out to you. All right, everybody. Thanks for being here today on this historic day as the NASDAQ finally breaks 20,000. And we will see you all tomorrow.